In Lancaster County, Pennsylvania, more than 44,000 old order Amish live and farm today. Almost none of them carry a credit card. Almost none of them have a credit score. And yet one small bank in that county has lent them hundreds of millions of dollars. And in 20 years, it has never lost a single cent on an Amish loan. That should not be possible. Every bank in America runs on numbers, payment history, credit utilization, a 3-digit score that decides who gets money and who doesn't. The Amish have none of that, and they don't want it. And still, they are the safest borrowers a small-town banker has ever seen. To understand why, you have to go back further than any bank, to a burning barn, a pile of horse-trading receipts, and a rule about who a person is allowed to owe. The Amish came to Lancaster County from Switzerland and Germany in the early 1700s, fleeing persecution for their Anabaptist faith. They were farmers who believed something specific, that a Christian should never be unequally yoked with the world outside the church. The phrase comes from the Bible, 2 Corinthians chapter 6. For most Christians, it's a verse about marriage. For the Amish, it became something much larger, a rule about money. An insurance contract, in their reading, is a yoke. It binds a believer to a company built on a stranger's calculation of risk, a system where premiums get collected whether disaster strikes or not, where the promise of protection comes from an actuary's spreadsheet instead of a neighbor's hand. To the old order Amish, that kind of arrangement doesn't just feel wrong, it replaces something they believe God assigned to the church itself, the duty of members to carry each other's burdens in person, without a middleman. This wasn't a new idea invented for Lancaster County. It came from the same Anabaptist movement that had already cost their ancestors everything in Europe: imprisonment, exile, and in some cases, execution, for the belief that faith should be a personal choice made as an adult, not a birthright handed down by a state church. People who had survived that kind of pressure to conform were not going to build their financial lives around conforming to anyone else's system either. Separation from the world wasn't just about clothing or language. It was about where you put your trust when something went wrong. So for 300 years, instead of buying that protection, they built it. Not a company, not a policy, a habit, repeated so many times it became a second religion of its own. The habit starts with the barn. Before insurance, before banks, before any of it, an Amish farm ran on its barn. It held the hay, the animals, the tools, an entire year's harvest. If lightning struck it, or a spark from a wood stove caught the loft, a family could lose everything they owned in under an hour. The response was never a claim form. It was a raising. Word went out by hand, a note passed farm to farm, or an announcement made after Sunday church. Within days, sometimes within hours, wagons and buggies started arriving. Men brought their own tools. Women brought enough food to feed 200 people. Children ran water buckets and stacked scrap lumber. Crews split themselves without needing to be told. Some framed walls on the ground. Some raised them into place with ropes and long poles. Some worked the roof before the walls below were even finished. By the end of a single day, working in teams that had done this 100 times before, a new barn stood where the old one had burned to the ground. Nobody sent an invoice. The family that lost the barn owed nothing, except the same labor someday for whoever's barn burned next. That was the entire contract, not a document, a memory held by everyone who showed up. It worked because the risk never left the community. A commercial insurer spreads risk across strangers in exchange for a fee, collected whether or not anything ever happens. A barn raising spreads risk across neighbors in exchange for nothing but the certainty that the favor comes back around. As long as the community stayed together, the system never needed a single dollar to change hands. But barns were the easy part. Money was harder, and eventually, money forced the system into writing. In the early 1930s, the country was in the middle of the Depression, and Amish farmers, like every farmer, needed credit to survive a bad year. They went to the Federal Land Bank in Louisville, Kentucky, looking for loans against their land. The bank had a problem. Amish farmers didn't carry commercial fire insurance on their barns. And to a bank, no insurance meant no protected collateral, and no protected collateral meant no loan. The Amish told the bank they already had a system. It had simply never been written down. So, in December of 1934, for the first time, A generations-old word-of-mouth practice of covering fire and storm losses was put into a printed document. It got an official name, the Amish Aid Plan. Under the plan, when a member suffered a loss, several disinterested men from different church districts would walk the property and estimate the damage. The community would then pay out 3/4 of that estimate, the funds raised through an assessment on every member family's own property value. A federal bank, chasing paperwork it could actually trust, is the reason the oldest form of Amish mutual aid finally exists in writing at all. By 1949, the version of the Amish Aid Plan covering communities in Ohio was backing more than $6 million in property. Lancaster County had its own version doing the same work close to home, the Amish Aid Society insuring barns and homes the same way, one estimate and one assessment at a time. The plan covered barns and property. It never touched the other place a family's savings could disappear overnight, a hospital bill. For that, the Amish never built a company. They built a doorstep habit. In every old order Amish church district, a man is chosen to serve as deacon, unpaid, untrained in finance, simply trusted. When a family faced a medical bill too large to carry alone, the deacon's job was to walk, farm to farm, door to door, through the district, asking each household what it could give. No bill was ever made public. No family was ever assessed a fixed amount. Giving was voluntary, private, and, in a community where nearly everyone shows up when asked, remarkably reliable. This is Congregational Alms, and it is the oldest working health coverage the Amish have. It still runs exactly the same way today, in the 21st century, using nothing but a deacon's memory and a knock on a door. But as hospital costs climbed through the 20th century, a knock on the door stopped being enough on its own. Lancaster County Amish built something to stand alongside it, Amish Hospital Aid. It works differently from commercial insurance on purpose. There's no monthly premium calculated by an algorithm predicting how likely you are to get sick. Instead, families pay a flat contribution, in recent years, roughly $250 a month, into a shared community fund. If a member is hospitalized, the first $1,000 of the bill is the family's own responsibility, the same way a deductible works in ordinary insurance. Above that line, the community fund covers the rest. Hospitals bill Amish patients the same way they bill everyone else. The difference happens after the bill arrives. The men who run the aid plan negotiate directly with hospital billing departments. And because Amish patients pay promptly and almost never sue for malpractice, hospitals often agree to a lower rate. By the mid-2000s, about 30% of Lancaster County's Amish families were enrolled. The numbers involved are not small. In a single stretch tracked by a local newspaper in the 1990s, the Amish Hospital Aid Program paid out $4.5 million in medical bills for Amish patients. With no insurance company, no government program, and no debt left behind for the families it covered. That habit didn't stay in the 1800s. It's still the rule today, even in the corners of Amish life that look the most modern. A small share of Lancaster County Amish, by most counts around 1 in 5, do carry a credit card, almost always for the discount or the convenience at checkout, never as a way to borrow. The bill gets paid in full every month without exception. A missed payment isn't treated as bad luck, it's treated as a broken promise. The only purchase most Amish families will ever finance at all is land or a house, and even then, the family shows up to the bank with 20 to 25% of the price already saved in cash before a single form gets signed. None of this happened without a fight. In the 1950s, the federal government began requiring self-employed farmers to pay into Social Security. Amish farmers refused. To them, Social Security wasn't simply a tax. It was public insurance, the same unequal yoke they had been avoiding for 200 years. Just wearing a government seal instead of a company logo. They believed caring for the elderly and the sick was the church's job, not Washington's. The Internal Revenue Service tried to collect anyway. Agents went after Amish bank accounts and found that most Amish families didn't keep money in banks at all. They tried attaching the checks Amish dairy farmers received from milk cooperatives, and found that the cooperative officers, many of them Amish themselves, simply refused to sign the paperwork. In the spring of 1961, in western Pennsylvania, the government ran out of patience. Federal agents seized 3 Belgian draft horses belonging to an Amish farmer named Valentine Byler, taken directly out of his field in the middle of spring plowing, the exact week he needed them most. The horses were sold at auction for $460 to cover roughly $300 in unpaid Social Security tax. When the government offered Byler a refund of the difference, he refused to take it. The story spread across the country. Sympathizers mailed Byler enough money to buy new horses before he ever touched the government's refund check. Byler himself called the seizure exactly what it felt like to him: persecution of a religious minority, carried out with a government auctioneer's gavel instead of a soldier's gun. Not far away, a bishop named Andy Byler, leader of roughly 1,000 Amish across 2 Pennsylvania counties, was blunt about what would happen to his community if Congress didn't act. Families broken apart by fines and property seizures, over a tax most of them would never live to collect a single benefit from. The pressure worked. It became the case that finally forced the question in Washington: could the United States require a religious community to pay into an insurance system its faith explicitly rejected? In 1965, Congress answered. Tucked into the same law that created Medicare was a narrow exemption. Self-employed members of religious sects that had existed since before 1950 and that were conscientiously opposed to public or private insurance could opt out of Social Security and Medicare taxes entirely. It was written, in practice, for the old order Amish. By 1988, the exemption widened again, covering Amish-owned businesses and their Amish employees too. The community that refused to be forced into one insurance system had just won the right, in federal law, to keep running its own. That exemption became the model for something bigger decades later. When the Affordable Care Act passed in 2010 and required nearly every American to carry health insurance, it carried the same carve-out, first written in 1965. Members of recognized religious sects opposed to insurance on grounds of conscience didn't need to buy a policy. The Amish didn't have to ask for a new exception. They were still standing on the one they had already won. An Amish man from Kinzers, right in the heart of Lancaster County, put the whole 300 years of it into a single sentence when a reporter asked him about the new law. "We don't want government paying for our things. We want to pay our own way." None of this meant Amish families faced fire, illness, or hardship alone. It just meant the risk moved somewhere else, onto each other, permanently, generation after generation. When a bill was too large for even the church fund to absorb quietly, the community had one more tool: the public auction. In Lancaster County, the Gordonville Fire Company held one every year, drawing Amish and non-Amish buyers alike. At its peak in the 1980s and 90s, a single auction could sell 300 handmade quilts in a day, the proceeds going to medical bills, the volunteer fire company, or a family that needed more help than the Deacon's rounds alone could cover. Now, go back to that bank. The banker who works with Lancaster County's Amish drives about 1,000 miles a week. He doesn't do it for exercise. His customers don't use online banking, don't apply through an app, and mostly don't carry a credit history any computer could read. So he drives to their farms and sits at their kitchen tables, and he evaluates each loan the way a small-town bank did 100 years ago, by looking at the person across from him. What he finds, loan after loan, is a pattern almost no algorithm was built to detect. These are people who treat a missed payment as a form of theft, an actual named sin, not a late fee. People who save 20 to 25% of a home's price before they ever ask for a mortgage, because debt, to them, is something to avoid everywhere except the 1 or 2 purchases, a farm, a house, that a lifetime of work is actually built around. People who, when a neighbor falls behind, are more likely to show up with cash than to gossip about the default. The modern financial system runs on the opposite premise, that a stranger's number, calculated from your past behavior, can predict your future risk better than any person could. It's efficient. It scales to hundreds of millions of customers an office will never meet in person. A premium, once approved, doesn't care whether the person paying it is trustworthy or not. It's priced against a pool of strangers, adjusted by a company that has never sat at that person's kitchen table and never will. The Lancaster County model scales to almost nothing beyond the community that built it. A deacon can only walk so many doors. An auction can only raise so much in a single day. A church district large enough to absorb a barn fire is still too small to absorb a citywide disaster. But inside that limit, it runs on something no algorithm has ever replicated. Everyone involved knows exactly who they are protecting and exactly who is protecting them back. A neighbor who shows up to a barn raising today is, quite literally, banking on the same neighbor showing up for him tomorrow. And in 100 years of records, that bet has almost never failed to pay off. That is why a banker with 1,000 miles a week on his odometer keeps saying the same thing about a community with almost no credit history at all. That in 20 years of lending to them, he has never lost a cent. The barn that burned was rebuilt in a day by neighbors who never sent a bill. The horses taken from Valentine Byler's field came home in the end to a family that never asked the government for anything again. The Deacon still walks the same roads today that deacons walked 100 years ago, knocking on doors, asking what a family can spare for another family they've known their whole lives. Nobody in Lancaster County ever signed a policy for any of it. There was never a company to file a claim with, never a customer service line, never a premium that rose after a bad year. There was only the promise that whoever showed up for you once would show up again, kept quietly, door by door, barn by barn, for 300 years and counting. None of it was ever built to make money. It was built, one raising and one knock at a time, to make sure nobody in Lancaster County ever had to carry a loss alone.